following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
All right, we are back, everybody. Appreciate your patience. Let's talk futures. Joining us live from the Chesapeake Bay area, Blu Putnam. Blu, how are you?
I am doing well today.
That's fan. It looks like you're ready to celebrate with that shirt you have on today. It's kind of fancy.
Oh yeah, I'm a Paisley fan. We're going out to a really great restaurant in Easton, Maryland, on the Eastern Shore for lunch. So it's going to be cool. And it's the end of the summer. You got to a few more weeks.
Yeah, I'm jealous. I don't know what Mrs. Keggs has planned for me this weekend. We'll do something.
Okay.
So she's in charge of the social calendar. I just go along for the ride.
That's a good ride.
Yeah, for sure. So anyway, thanks for being here with us. This whole week has been nothing but information and data on jobs, unemployment, going across the board, JOLTS, Challenger grade job cut, ADP employment, jobless claims, and now the employment situation. The focus is on jobs anyway, right? At this point, the second part of the dual mandate.
Yes, the inflation has come down. It's not to the 2% target, but it's clearly not going back up. And so the Fed has shifted gears and says that now we got to pay a little more attention to jobs. It's a more balanced view from the Fed.
Okay, so yeah, this morning we even had, I think John Williams pretty much said, and he used the word I'm ready for a cut. He didn't say we or the board or the committee or the people. He said, I'm ready for a 25% cut, or not 25, a cut.
Yeah, the Fed's been very, very careful not to tell us how much, which I find a little fascinating because, in the era of forward guidance, which really started with Bernanke back in 2008, the Fed really likes to tell you ahead of the meeting and ahead of the quiet period, when they're not talking the 2 weeks before, what they're going to do. And this time, we know they're going to cut. I mean, Jay Powell told us that in Jackson Hole, but 50 versus 25 is still in play this morning.
Yeah, and well, it's interesting because a lot of the talking heads this morning, and this happens all the time on the news media, on Bloomberg, and Reuters, and and other places, where they say, well, okay, if the unemployment number, the employment situation number comes in here, if it's a double digit, we're going 50. If it's a triple digit, we're going 25. So they make these kind of projections, right? And we were in the triple digits.
We were in triple digits. Of course, we revised the previous months down. So if you anyway, the point is that when you make up those little rolls, you're always going to be wrong because something in the data is going to surprise you. Yeah. And in this case, this data to me is a 25 basis point piece of data, but the market has been all over the place since the release. So it's still very much a debate. Yeah,
I was talking to your protege earlier this week, Eric Norland.
Eric Norland, yes.
And we were talking about all these revisions. The big revision that we just had, the annual revision, and then we had what 86,000 revised down for June and July for this employment number. And even Eric, who never says anything bad about anybody, raised his eyebrows at that 800,000 revision.
Well, first of all, it's not a revision yet. They told us that their March data was 800,000 too high on the level. Okay. But the actual revision occurs when they release data back in early next year in January. So they'll be able to calibrate June and maybe September. The 800,000 is always a little not so good with immigration, and we've had a lot of that. Then they spread that number out over all 12 months using their seasonal factors. And what you end up with, you do end up with lower levels. I don't think it's going to be 800,000. I think it's going to be more like 6, but it doesn't really matter because the pattern's not going to change. They're just going to move the whole graph down a little bit. And I don't think it's as big a deal as Wall Street was trying to tell us, but you know, they got us all excited about it. By the way, it happens every year. We just decided to pay attention this year.
Yeah. Well, and they made a big deal of it, and you know, painting the picture that, you know, these numbers aren't to be trusted, which to your point, you just got to, you know, you got to just look at it on a long-term basis. And if it's always adjusted this way, then you should expect it.
Yeah, and by the way, these are the best numbers in the world on this stuff. I mean, the U.S. Bureau of Labor Statistics, they do an awesome job. And in fact, the reason they go back and benchmark in March is they're looking at the state employment rolls, the unemployment insurance. It's the best data. It's not a survey. And they do this every year. They're doing their job correctly. So it's not that you shouldn't trust the data. But I got to tell you, if you're worried about the actual level of employment, then it's a, you know, it's a small revision. 800,000 sounds big, but in percent terms, it's less than 1%. And then you're going to look at the pattern and you're going to say, hey, pattern's not all that different. We're still creating jobs. We're not going into a recession. What was I thinking getting worried about this data? I was thinking I could get people excited and maybe trade when they shouldn't.
Yeah, no, that's an interesting point. Less than 1%, and well, what you would think is a huge number, 800,000. It's like, no, that's only that. It's a nothing burger right there.
It really was. You know, they made a lot of something, and it will be a bigger result. You know, we're going to talk about this in January when we come on when they really do it. But I don't think you're going to. If you took the scale off the graph, I don't think the change in payrolls would surprise you or be any much different.
Yeah, I gotcha. Well, let's take a look at some of the charts you sent because they were pretty awesome. I didn't have too much time to study them because I was blabbing with Tom Schneider as usual in the morning. So let's take a peek. The first one, U.S. employment rate is a percent data available through August 2024 as of September 6th.
Yeah, I always give a date on my charts. But anyway, we went from 4.3 to 4.2. You can't even see it in this chart. 4.2 is a very low unemployment rate. Obviously, if you look over the 70 years of history here, this is not a recession forecast yet. Time for the next chart.
Well, but hang on though. So that 4.3 number, my understanding is it was really like 4.95 or something, right? They rounded it up. So this could be, for all we know, I haven't dug into it yet. It could be 4.224. You know what I mean?
You know, I haven't dug into it either because I don't, and I promise you I won't.
Yeah.
You know, when you go into the second, third, and fourth decimal places, you are so far in the weeds, you're not going to get anything right.
I'm usually always in the weeds, so I hear you. All right, let's go forward here to payroll, net new payroll employment jobs.
Yeah, now this is the one where they revised the last 2 months down. So we are actually up from last month, even though I'm in the weeds here. We're down from what was announced last month.
Yeah.
So, you know, it's pretty weird. But you know, look, you can see this number bounces all around. It's starting to stabilize. Many economists, myself included, are looking that we're going to average more like 75 to 125,000 a month for the fourth quarter. And that's not a recession forecast. That's the end of the post-pandemic job surge. So we're finding a new equilibrium, but we are not going into a recession.
So are we going? So in other words, are we going back to trend, pre-COVID trend?
Approximately, I think it'll be slightly lower than pre-COVID trend.
Okay, I gotcha. I haven't looked at the Fred charts myself either. So, all right. So we're not going to hit the panic button yet, is what you're saying?
Oh, absolutely not.
All right. Job openings.
So this data came out a little bit a week ago, but the what it tells us is that job openings are back to 2019. And so again, same point, the post-pandemic job surge, it's done. Now we're trying to find out where our equilibrium is going forward.
Yeah, so as I recall, if I'm right, my memory serves me correctly, and Jolts as an example, they had these openings, but it was weighted. It was 80% services, 20% goods. Is that consistent with what our economy is?
Yes.
Okay. It always when everyone says to me we have a services economy, I forget the fact that it's more than just cooks and waiters at restaurants.
That's right. You, my friend, are in the service economy, and so am I.
That's right. I'm not manufacturing anything.
We're not well, we're manufacturing for cash, but we could
Yeah,
use some quality control, I guess.
right. We don't need a warehouse for that. All right, let's keep rolling here. Let's go down to U.S. Weekly new employment claims.
Okay, this is the data that caused that revision you were talking about, because they went back and said, well, what was the employment situation in March based on all the state data? I mean, the payroll data is a survey. And so it's really nice to have some real data. By the way, if you look at this data, the non-seasonally adjusted has come back down pretty low. That's the red line. The black line is flatlining. There's nothing going on here unusual. So no signal one way or the other. It continued, no recession, but not great growth. It's just business as usual.
Yeah, so it's funny because me and Tom were looking at this yesterday, I believe, and we were using a Fred chart going back to 2010. And it seems like the sweet spot is really 220,000, 225,000 on that long-term average basis.
It is now. It used to be, we said that if the unemployment claims went above 300,000 a week, it was time to hit the panic button. But now you hit the panic button a little lower, and that's why people got upset when it was getting pretty close to 250. But if they had bothered to really understand the seasonals, they wouldn't have gotten upset. They would have just said, I need some more data.
Well, seasonal, you have data dependent. But seasonally, it's like makes sense to me for this kind of statistic because you've got summer jobs, you've got teachers, you've got ramping up for Christmas deliveries and stuff like that. So that makes sense to me in this to do it that way.
Oh yeah, the December, January is a huge seasonal adjustment, but also the August, September around the kids going back to school, the teachers going back to work, and that has changed a lot since the pandemic. So it's pretty tricky. Seasonally adjusting weekly data, it's an art, not a science.
Yeah, but it makes sense though. You got bus drivers, you got crossing guards, you got janitor, you got all sorts of stuff. Yeah, I got you. All right, let's keep rolling here. Everything is on point. CME FedWatch tool. Yeah,
this is the CME FedWatch tool. Now, this snapshot was taken before the data came out, the jobs data today.
Yeah, I'm going to take a peek at what it is right now.
Yeah, well, I'll take a peek for you. And if you looked at it right now, it's not that different.
Okay.
They've moved up the 50 basis point cut has gone from 39% to 43, and the 25 from 61 to 57. But that's absolutely right this second. If you had looked at this earlier, right after the number, a lot of people said, wow, we're definitely doing 50 because they thought it was a weak report. And then they backed all the way off of that. And the interesting thing about this chart for me is that we're entering the quiet period on the Fed, so they're not going to tell us anything after today. And usually, Ben Bernanke, Janet Yellen, Jay Powell, they like to go into the meeting with the market pretty much understanding what they're going to do. And this time is different. It's roughly 60-40, give or take. And that debate is going to rage until September 18. By the way, just for the record, I'm in the 25 basis point cut camp. I think the Fed doesn't have any reason to panic. 50 basis points would signal a distinct worry about a recession. If the Fed's worried about recession, they can cause everybody else to panic, and that's not their goal.
Yeah, that's what me and Mike Burke were talking about. It's like, hey, at 50%, everyone's going to be a little bit. Are we behind the curve, right? Everyone's going to say, "Oh, Fed's behind the curve again. They did it again."
And they are behind the curve, but they're not that far. And they can, unless you really are sure there's going to be a recession, 25 basis points is okay. I mean, and by the way, I don't think they're going in November either, because that's the meeting 2 days after the election. We might not even know the results 2 days after. The last thing the Fed wants to do is be in the headlines that week.
Yeah, no, I hear you. I'm in the 25 basis point camp too. Right now, if I had to predict, I'd say 25, 25, 25. I don't think they care about the election, but that's just, what do I know?
Well, I think the next chart is worth talking about then.
Well, but hang on though, before we go there, let me just ask you, the conventional wisdom this morning, again, with the talking heads and all this newspapers I read in the morning, suggests that Governor Waller's speaking at 11. Actually, he might be speaking right now for all we know, 11 o'clock today. And supposedly his mission is to kind of inform the world, inclusion's a bad word, but, in consultation with Powell and everybody else, the final thought on what the Fed's thinking in the last very moment before the quiet period. Is that a possibility? They wheel them out and say, okay, Waller, you say this and that?
It's possible. I would be incredibly surprised if he was so specific as to tell us the answer, 25 or 50. Okay. If you listen this morning with John Williams, he still just said the word cut.
Yeah. He's in for a cut. All right, let's keep rolling here. Next chart, Fed expectations as of September 5th, 2024.
Okay, the red lines are meetings. Okay. What this chart tells me is the market is thinking that we're just going to get a whole sequence of cuts. And by the way, that's what the Fed likes to do. They don't want to make the first cut till they're sure they can make a second and third cut.
Yeah.
And they are now, we think, sure. And this one agrees with you that there'll be a cut in November and a cut in December and so forth. I'm still in the camp that it's cut, pause, cut in next year.
Okay, so you're talking about 125 basis points relatively quickly,
but not by the end of this year.
No, correct, right? You're into March.
Yes.
Yeah.
Which, by the way, hardly matters.
What do you mean?
If you're
just
a business,
because
you're not going to change your investment decision because the cut comes in March instead of January or April.
Yeah, but if you have to borrow and you're trying to time it, right? You're waiting for your moment to shine, and you get 3 or 4 cuts in a row. You got to ask yourself, all right, are we done for a while? Should I lock in now or not? And that's where I think it's going to be tricky.
When you use that word lock in, I'm thinking you're talking about a mortgage or a longer term thing. The 10-year has already priced in all of this stuff. It's not moving. So the only thing you would be, if you were doing a floater, you might care about it. But if you're doing a longer term loan, the 10-year is already ahead of the Fed. The 10-year is not behind the curve.
Yeah, so I've been tracking the CME Group has this micro yield product, which I've been tracking. It's the numbers are a little different than you see in the cash world, but the 10-year now we're not inverted anymore by about 11 basis points as of this morning, according to that set of data. We're reverting back to normal.
Yeah, I don't know if I'd use the word normal, but we're definitely flat on the yield curve now.
Well, flat
from
curve.
Twos to tens.
Yeah,
twos to tens is flat, but not from Fed funds to tens. And that's why I said the Fed's behind and the bond market's not.
Okay. Yeah, I always said
I'm a bond
smart.
guy, and I tend to think the bond market is the smartest market there is. So
Oh,
what the,
how
you
many?
know,
Yeah, I have said this. I have said this to Tom Schneider since the day I met him 2 years ago. The bond market's the smartest market. Look for that first.
that's, you
Great
know,
minds
I
think
mean,
alike, right there.
but you know, the equity guys, and I love the equity guys, but they're all into the individual stocks as well. They should, because that's what they do. And you know, but
Yeah.
if you're an expert on all the individual stocks, your market timing capability is not necessarily that good. The bond guys are really looking at the big picture. So that's my
Yeah.
explanation why I follow them a little more on questions like this.
Yeah, no, I agree. And equity markets are a different animal. I mean, you get 401k contributions, just keep buying, keep buying, keep buying. It's designed to go up.
Right. And it
All
should.
right, all
We're a
right.
growth economy.
Yeah. All right, let's keep rolling here. Where are we at here? All right, we got a couple more
This is
charts
this
here.
is the
Yeah,
number of 25 basis point cuts by the end of the year. 4 cuts, which is what the market's telling us as of last night, would be 100 basis points, 1%. And I think this chart's going to move around tomorrow.
yeah.
I
Because of
just,
the yeah.
yeah, I just can't see a full 1% cut between now and the end of the year. But, you know, hey, it could happen.
Yeah, no, I know. I think slow and steady wins the race here.
Yeah, I mean, the Fed is always slow and steady unless it gets surprised by some seriously bad news. And we don't have seriously bad news. So they're going to take the stairwell down until something bad happens, and then they'll jump. But I don't see anything bad happening right now.
Do you think that the Fed also has one eye on what the ECB might do?
Well, yeah, they have an eye on it, but they also could care less. I shouldn't say care less, but it's not going to influence their decision. Uh, the Fed really doesn't worry about the dollar. The ECB will tell you they don't worry about the euro, but they do. But the
Well,
euro's
it's
been up a little bit. It's gone from 108 to 110 to 111. So it's no longer a concern. So the ECB can make their next cut anytime they want. Not a problem.
oh, it's a big concern. I'm going to Italy in a few weeks and I haven't converted any money yet. So it's a problem.
Oh, well, you missed the chance, but you've only lost 2% by waiting.
Oh no. But yeah, so but there are jokes aside, there are ECB members that have said publicly recently that hey, if the Fed cuts, it gives us more ability to cut also.
Yeah, and that's an exchange rate view. And they've already cut once.
Yeah.
But you know, the difference between the ECB and the Fed in terms of interest rate differentials is pretty small.
Yeah.
So it's really where you think they're going to end up is driving things, and they're not going to end up that far apart. Their timing might be a little off, but
Yeah.
they're not going different places.
Right. Makes sense. Right. Makes sense. But for currency traders, those little nuances are important.
Yeah, for shorter term currency traders, it's been important.
Yeah. All right. CPI. We're back to inflation here.
It's hard for me not to put one inflation chart in when we're talking about the Fed. This is the headline inflation rate, CPI. You know, it comes out in the middle of the month. But what you can see on this graph is we had an inflation surge, we came back down, and we got stuck. We are trending a little lower. My forecast is we go down from 2.9 to 2.8. Forget that second decimal point. I shouldn't have put it there. But we're not going all the way to 2. But I don't know that the Fed is all that worried. Once they understand that inflation's gone down.
But we've been hit with I don't know how many months in a row, 24 months, 18 months in a row, with Fed guys saying, nope, we're sticking with our 2% goal. We're sticking with our 2% goal. I never thought we were going to get there either.
Well, they're sticking with their 2% goal, but they have changed their rhetoric a little bit to as long as we're making progress toward 2% and we're getting close, then we can start adjusting rates. So the 2% goal is there because they don't want to move the goalpost I mean, the Fed has a few credibility problems, so moving the goalpost wouldn't help that. But they're moving toward 2%. So they can cut, and they will cut. I mean, they've told us they're going to cut. They're not going to go back on that.
Yeah, but wouldn't the world respect them a little bit more if they said, "Hey, listen, this 2%'s out of date. It's random. We think it's 2.42 or something." You know what I mean?
Uh, well, the Wall Street analysts and the press corps will take the Fed to task no matter which way they go.
Yeah.
It's a no-win for the Fed.
Yeah.
So I understand why they're staying with 2%. I think they'll change that 2% to a range, but I don't think it'll happen under Jay Powell.
Got it. Let me ask you this. Tom Schneider asked me this question this morning, and I scratched my head a little bit. I think I know the answer, but is there a chance that Vice Chair Williams could become, there's a two-part question, could become FOMC chair if Powell leaves? And then secondly, would he even want to?
I can't speak for John Williams. I can guess he probably would want to. Is he likely to get picked? I would put it at fairly low odds, but that's a political judgment and not a Fed judgment.
Okay. Because I was arguing that there's probably a pretty big salary differential between the head of the New York Fed Bank and then the political appointed Powell.
Yeah, but if you're on the Fed board or a Fed president, you're not looking at your current salary. It's your after you retire salary is huge no matter what.
Yeah. Okay.
So they don't care what they're making today. They already have been given an excellent chance to open their mouth and get paid for a long time into the future.
Yeah. But there's also prestige being the CEO of the New York Fed, right? You're running the trade desk, you're driving you're pulling all the levers. You are the bank. There's the global bank to look at.
Yeah, I mean, my first job as a PhD economist was the New York Fed. I worked for Paul Volcker. He certainly enjoyed that position, and then he got to be Fed chair. So it's not unheard of. It is the only Fed, it's the only regional Fed with a permanent seat on the FOMC. And like you say, it runs the money market desk. It's a pretty important Fed.
Yeah, no, for sure. So, all right. So let's kind of recap here, Blu. The Fed shouldn't be worried too much about anything, right? Jobs seem to be, a little bit weak, but no one's worried about a major recession happening tomorrow. Interest rates are CPI is going the right way, right? Inflation is going the right way. So a soft landing here?
In the words of Wall Street, the soft landing is in play, but I hate that analogy, and I'll tell you why. If you have a hard landing, the plane comes to a dead stop quickly. If you have a soft landing, the plane lands on the runway very smoothly and you come to a stop. We are not stopping. Okay, we're going to continue to fly. It's just we're going to fly at a little lower speed and maybe a little lower altitude. The potential GMP is more like 1.5 to 2, maybe 2.25 max. We're no longer a 3% economy. We're not even a 2.5% economy on trend. But, so the flight path slows down a little bit. And that's demographics, by the way. That's not the economy screwing up or anything. That's just the demographic headwinds of all of us baby boomers retiring and not enough young people and all this stuff. So but anyway, yes, we are in the jargon of the press and Wall Street, we are in the soft landing scenario, but we're in the growth, we're equilibrating to a slower growth, but not that slow, 2%-ish.
Yeah. All right. Well, that's all good news, Blu. Listen, I appreciate you being here, especially on a Friday. I know you have big plans. You're going to get some crab cakes or something in Maryland. That's that sounds awesome.
Yeah, my work week, I think, is about to end in 10 seconds whenever you sign off.
I have to wait. We're going to sign off right now, though. Again, Blu, have a great weekend. Thanks for being with us. Looking forward to our next chat.
Thank you.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.